Hello YouTube. This is your boy Joseph from the Common Investor channel. I hope you lot are doing very well. It's been a while since I've basically released a video, but I'm back with a gift to you guys, or at least for the dividend investors, which I believe there are quite a few of. I think there are more dividend investors than actual growth investors nowadays, from what I can see on YouTube, anyways. Growth investors tend to be more traders than actual investors. Um, but yeah, it's nice to be back. And as I said, I've got a present for you. And this is a company called EMIS Group, essentially. It's quite a good company from what I've seen. And I just wanted to share the information with you. And obviously, this is not financial advice, so please do your own research. And if you like it, please by all means help yourself. You know. So basically, EMIS Group is basically provides software, healthcare software, information technology, and related services for healthcare professionals in the in the United Kingdom. Essentially, it's based in the United Kingdom. Yeah, it's been a long day, guys. So obviously the P/E is quite high at 30.6 times price to earning ratio, but you got the industrial average essentially for healthcare services is around 42.4. So I'm wondering why that's the case actually, but I'm guessing it's because of the COVID-19 issue. So maybe a lot of people are investing in the healthcare sector, which makes sense. Obviously, earnings are forecasted to grow at 11.3% per year. I don't think that's an analyst estimation. That might be a bit optimistic. Maybe you know something I don't know, but they probably do anyways. Because earnings grew by 1.5% over the past year. Yeah, so from 1.5 to 11.33%. Except maybe the actual company is catching traction, but it already covers a lot of this sector anyways. So I wouldn't expect that to be the case. And also, it pays a high dividend and also reliable dividends as well. So I think it's been paying this for quite a while, and we'll kind of go through this a bit later. Before we get there, just gonna talk you through why I like this company as a dividend play, and yeah, I just go through it. So essentially, it's quite a sticky business. It basically is deeply embedded in the workflow for pharmacies and healthcare practices across the UK, and also switching away from such a system tends to be quite expensive, disruptive, and requires training and it's not just a smooth process essentially to change from one system to another. So essentially, the healthcare industry tends to stick to what's already there. Believe me, I've worked in the healthcare industry, and if it's not broke, don't fix it. That's kind of the typical approach. Just because just getting new stuff essentially is a bit of a usually is a bit of a mess. Transfer of data, validating it, all those little bits and pieces is always a bit tricky. Data security and all that. Um, yeah, and also for this reason, as I said, the products, EMIS products, will stay on board for quite a long period of time. They have a secure recurring revenue in the sense that well, apart from the fact that it's recurring as well, it's most of your own revenues derived from the public sector organizations, so which makes it also secure as well. Um, it's they basically it's a strong software business, and they it's a cash generating business as well. Um, and this basically allows it to continue paying dividends even throughout the COVID-19 outbreak. They do have recurring revenue through subscriptions, and I think depending on the contract arrangement with the customers, they can actually put forward an annual price increase on the actual fees. So that's something to look into. And even though there's an annual increase on the actual subscription, because it's just such a sticky business, you wouldn't naturally find the customers going to a different subscriber essentially. Yeah. So it also has a good market share. So at the moment, it serves about 57% of the English GP surgeries, and this is almost double the amount of its next competitor. Um, it's it also covers about 36% of pharmacies, and also those two sectors essentially cover for about 70% of the group's revenue. Um, this includes the other 30% basically includes the A&E community cares and special need niches as well. Um, Another source of income apart from their software products is it's if you got a software provider, another software provider that wants to link into their database, then they can essentially, but EMIS will basically charge them another fee for doing that. Uh, and obviously as they cover quite a wide range. They cover quite a wide range of the markets already. You're definitely going to be having software providers, trying to get your service. So that's another source of income for them. As far as growth, obviously it's not a growth monster, um, but it's quite for if you're looking for a dependable company that has a consistent revenue coming in, and it's got quite a sticky model. That this is possibly a one that you want to be looking into. Data security as well. The obviously the cloud is a cloud service, and this is essentially hosted by the Amazon AW Amazon Web Services division, and a lot of companies use this web service, and it's quite reliable and is known. It's a reputable name basically. Uh, Company's vision is basically to be the ecosystem of healthcare, which allows the healthcare professionals to securely access patient data um, anywhere and whenever and wherever, essentially. The risk for the actual stock itself is that they're trying to introduce a new platform, and obviously, with introducing a new platform, there will need to be some work, some additional work to take place. It's not as simple as just installing the software. Um, there might be some glitches in the software and this and that. So that's really unclear as to how that's going to work. But I just take you on the fact that they've done this before. They've learned from their mistakes, and hopefully this time it's going to be a much smoother transition. Um, but if worst case scenario comes in and it's not necessarily a smooth transition, they do have a nice recurring revenue. They are a sticky business, and um, they have really good balance sheets as well, which we'll go through a bit later. So currently, I believe the share price is about £10, 68, and it's there was a dip to about £8 around March, and I think there was a bit of investor insider buying around this point. So that's quite nice to see essentially. And personally, if I saw the stock around this level, to me that's a good point. Anything below £8.70 would be a point to buy. I think I bought around £10. I would say I think I bought around £10, mainly because I like the stock. It's a good dividend play. Not really looking for something that because it's not a growth monster, but it's gonna be, as you can see in the last 5 years, it's basically maintained um, a price between 9 to I think 12. Let's go to max. It's actually well, it's quite a decent grower in the sense that it, I mean, it's not a Tesla or Shopify, but it's in okay for what it is. um, so if you look into in terms of returns, basically from the actual stock, if you take into consideration dividends as well, you see you get a decent growth over the next 5 years. And if you compare that to the market, it's actually beat the markets essentially. So I guess for in terms of the FTSE 100, I don't know what this market's what market is comparing it to essentially, but I'm just guessing it's the FTSE 100, and it's beating it. Yeah, so that's essentially good enough. From an industry point of view, it's quite close in the industry standards, but yeah, that's pretty good in my opinion. I think if we go back to the 3 year, you also see there's quite a few dividend increases over the year for my loyal dividend investors, and I'm sure you'd be happy to see this. And I think it's something that's basically just gonna happen and continue over the course of this company's lifetime. Mainly because, obviously, as I said before, on an annual basis, they do increase the subscription fees. So how high they can go with that, I'm not sure, but I don't think it's going to be a problem for now. Um, so yeah, so the PE basically is quite high. Um, it's also an overvalued company, but to me, this is one to keep in your um, this is one to keep in your watch list. And if it does drop below, I think £8.20 or £8.27, then I think it's one to load up on. As I said, it dropped to about £8 before. So I, if I caught it by then, I would have definitely bought around £8. Um, yeah, price to earnings is not very good, but from an industry point of view, it's doing better than the industry, or it's cheaper than the industry average. But yeah, that's pretty much the same. That's all good. Well, it's not good, but you get me. Future growth estimated to be 13.3%. So I do not know read how that's within the next 1 to 3 years. So maybe it's catching a bit more traction because of the whole COVID-19 thing. So it could be that maybe more healthcare professionals might opt to actually get the software installed within your system, and then which would give the company itself a bit more growth and also more exposure within the market, thus increasing revenue and earnings as well. So that could be the way the analyst is seeing it. I'm not too sure because obviously this year they've only grown, or the past year they've only grown by no just under 2%. So earnings and revenue growth forecast. Essentially, the earnings basically has been stable over the past couple of years, and it's not really expected to go anywhere essentially. But it's a nice, stable, recurring earnings and revenue. So you're definitely going to be there's not going to be any dividend cuts, especially in this time, because no one knows when this layoffs are gonna. No one knows when the economy is gonna go back to normal. But I believe for this company, I think it's as long as they can maintain the the revenue and earnings that are coming in, which I believe they can, then dividend should be coming in as well, which makes it a good dividend play. Um, Earnings per share, it's expected to increase over the next couple of years as well, which is quite a good sign. And yeah, that's essentially it. So there's expected to be some growth within the company, not just massive growth. Uh, Past performance, um, yeah, it's not. As you can see, it's not necessarily that great from an earnings point of view in terms of growth. But hopefully, with a bit more traction after this COVID-19, as I said, there might be more healthcare professionals wanting to install this within their systems, and that could, kind of propel growth essentially, which is possibly why um, there's an 11%, 11.3% expected growth over the next 1 to 3 years. Earnings and revenue history. Once again, we've kind of covered this already. Uh, you know, Revenue is pretty much it increased at some point, but pretty much it's quite stable. Earnings is pretty stable as well. They had some glitches quite over here. I'm not too sure why that is, but essentially it's rebounded and it's quite stable as well. Uh, think the rest of it is pretty much okay. Obviously, as we've talked about before, in terms of growth, it's pretty much, it's not a growth machine. But everything else seems to be okay in terms of return on equity. We got 21.2%, which is pretty good. Return on assets, they're higher than their industry average, which is pretty good as well. And also return on capital, which is quite good. Financially, they're pretty solid, pretty much zero debt, and yeah, equity within the company essentially is quite good compared to debt, anyways. Equity to debt ratio. Let's say the cash, and they've also been building up the cash reserves as well, so that's quite good to see. The debt going down, and at the same time, um, you know, cash reserves basically going up as well. So the company basically does cash flow, and there's a genuine um, there's a genuine source of income for the business, so that's pretty good. Dividends, as we talked about before, they've been increasing but this goes from 2011, but they have been increasing the dividends every year, uh, and even this year they increased it as well around March, and an increase is expected again later this year, December, uh, towards the end of the year. So it's a nice it's a nice company. They're going to be increasing their dividends, revenue and earnings will increase, but at a slower rate than you know growth companies, which is expected. Currently, the payout is at 88%, which to some dividend investors that's a bit too high. But for me, I feel like I believe it's okay. It's okay for this company, obviously, because as long as it doesn't go beyond 100, I think is a case where um, as the revenue from subscription increases, I think that's going to increase on an annual basis, and from the look of things, we're just going to be eating bits and pieces of those over the long run. So as long as that's managed properly, then that's okay. And obviously, if there's a huge growth within the company and there's an increase in revenue for maybe other products that they want to introduce into the pipeline, then that's quite good as well. From an insider buying point of view, as I said before, I mean it's not much. I think for this kind of company, someone that's willing to put £73,000 in. I mean, what does the CEO earn? That's okay. Well, he earns quite a bit of money. Uh, yeah. Well, one of the CEOs basically invested a bit of money into it, £73,000. So yeah, at least there's some confidence within the company that is putting a bit more money into it. So that's quite nice. Um, and also, you can see it's owned by quite a lot of institutions, especially as you can see, and this is usually quite a good sign, because obviously these guys essentially they know what they're doing, and they essentially, I think any institution that invests into this would invest, and not necessarily they're investing for they're investing into it as an income producing stock, not necessarily for a growth stock. So that's quite good to see, and there'll probably be in quite a few funds and all that kind of stuff. So yeah, I mean I think that's pretty much it. Yeah, so thanks for watching. It's been a pleasure going through this stock with you, and I'll be releasing a portfolio video next week Saturday. I promise I will this time. And yeah, stay blessed, guys, and take care of yourself. Okay. All right. Bye.